Welcome to the Bookkeeping Puzzle Lesson 5. Debit and Credit Equation. In Lesson 4, we learned about debits and credits. In this lesson we'll dive a little deeper. What we'll learn: 1. What account normal balances are. 2. How we convert the accounting equation to the debit and credit equation. 3. How to use the debit and credit equation. Let's find out what normal account balances are. In bookkeeping, the concept of a normal balance is the foundation of the double-entry accounting system. Simply put, an account's normal balance is the side of the account, either debit, left, or credit, right, where an increase is recorded. Think of it as the account's home base or natural state. While an account can have a balance on the opposite side temporarily, it should normally carry a positive balance on its designated side. The major account's normal balance. Assets have a normal debit balance. Liabilities have a normal credit balance, and the equity accounts have the following normal balances. Owner's capital has a normal credit balance. Owner's retained earnings has a normal credit balance. Revenue has a normal credit balance. Draws and dividends have a normal debit balance. Expenses have a normal debit balance. The why behind draws, expenses, and revenue. You might wonder why draws and expenses have a normal debit balance if they are part of equity, which has a normal credit balance. Revenue increases equity, capital, so it shares equity's normal credit balance. Draws and expenses decrease equity, capital, so they have a normal debit balance. To show a decrease to equity, we use a debit. Therefore, recording a draw or an expense means debiting the draw or expense account to track how much equity has been reduced. Hopefully, debits and credits are no longer a mystery. A handy memory trick: dealer. A classic and highly effective acronym used to remember normal balances is splitting them into two groups, DEA and LER. DEA, normal debit balance. These accounts are increased with a debit, normal balance, and decreased with a credit. Dividends/drawings. Expenses. Assets. LER, normal credit balance. These accounts are increased with a credit, normal balance, and decreased with a debit. Liabilities. Owner's equity. Revenue. Mastering the normal balance of these 5 account types makes analyzing transactions and troubleshooting errors in a general ledger much more straightforward. Now we'll explore the debit and credit equation. Draws/dividends plus expenses plus assets equal liabilities plus owner's capital plus revenue. To understand how we get to the final debits and credits equation, we have to look at how the fundamental accounting equation expands, and then use some basic algebra to rearrange it. The goal is to get all the accounts that increase with a debit on one side, and all the accounts that increase with a credit on the other. Here is the step-by-step breakdown of how we convert it. Step 1. The base accounting equation. Every business starts with the foundational concept that everything the business owns, assets, is financed either by borrowing money, liabilities, or by the owner's own money, equity. Basic accounting equation: assets equal liabilities plus equity. Step 2. Expanding equity. Equity isn't static, it changes constantly based on business operations. We expand the equity portion of the equation to show exactly what increases it and what decreases it. Owner's capital, investment increases equity. Revenues, increase equity. Expenses, decrease equity. Draws/dividends decrease equity. When we substitute these into the base equation, we get the expanded accounting equation. Assets equal liabilities plus equity, owner's capital, plus revenues minus expenses minus draws/dividends. Step 3. Eliminating the negative signs, the algebraic pivot. In traditional accounting, we don't like dealing with negative signs in our core equations. To get rid of the minus signs next to expenses and draws/dividends, we use basic algebra. We move them to the left side of the equal sign. When you move a negative term across the equal sign, its sign changes to positive. Move draws/dividends to the left side plus draws/dividends. Move expenses to the left side plus expenses. Now, the equation looks like draws/dividends plus expenses plus assets equal liabilities plus equity, owner's capital, plus revenue. Why this matters: the debit and credit rule. This final algebraic layout perfectly mirrors the rules of double-entry bookkeeping. The equals sign acts as a dividing wall. The left side, debits. Draws/dividends plus expenses plus assets. These accounts sit on the left side of the equation. Therefore, their normal balance is a debit, which means left. To increase any of these accounts, you debit them. The right side, credits. Liabilities plus capital, equity, plus revenue. These accounts sit on the right side of the equation. Therefore, their normal balance is a credit, which means right. To increase any of these accounts, you credit them. This equation becomes a foolproof map for matching transactions to their proper debit and credit columns. Did you see how this equation is also derived from the dealer acronym? Now, it should be simple to determine when to debit or credit an account when entering transactions using the debit and credit equation. Debit and credit equation. Draws/dividends plus expenses plus assets equal liabilities plus equity, Kuehner's capital, plus revenue. Our new debit-credit rule. The types of accounts on the left side of the equation use a debit to increase and a credit to decrease an account's balance. The types of accounts on the right side of the equation use a credit to increase and a debit to decrease an account's balance. Debit and credit equation. Draws/dividends plus expenses plus assets equals liabilities plus owner's equity plus revenue. Normal debit balances equals normal credit balances. Debit balance accounts equals credit balance accounts. In this equation, all the normal debit balance accounts are on the left side of the equal sign and all the normal credit balance accounts are on the right side of the equal side. Debit-credit rule. All the type of accounts on the left side of the equation with a normal debit balance are increased with a debit and decreased with a credit. All the type of accounts on the right side of the equation with a normal credit balance are increased with a credit and decreased with a debit. Hopefully, debits and credits are no longer a mystery.